Welcome to the Markets Mindset. Today we're breaking down something most retail traders never understand: why algorithms need you to lose. Not because the market is out to get you, but because the structure of modern markets is designed around one simple reality. Your predictable behavior is the fuel that algo traders, liquidity providers, and institutional systems survive on. Let's simplify this without conspiracy theories, without doom, and without the usual retail victim mindset. You're going to understand exactly where retail gets positioned, why they get trapped, and how you can stop feeding the machine. Let's get into it. The first thing you need to understand is that algorithms don't hunt your stop specifically, they hunt clusters of stops. A single trader means nothing. A cluster of 500,000 identical retail behaviors. That's opportunity. Think of market movement like water flowing downhill. The water is attracted to pockets of liquidity, places where a lot of orders are stacked together. Those pockets are almost always created by retail traders doing the same thing at the same time, the same way, every single day. Where do those pockets appear? At obvious highs and lows. At swing points, at double tops, at double bottoms, at textbook support and resistance, at trendline breaks, and especially, at every perfect entry retail thinks they've mastered. Whenever the majority of retail starts piling into something predictable, algorithms adjust and position against it, not out of malice, but because that's where the money sits. When you place your stop below a swing low, do you think you're the only one? No. Thousands of retail traders see the same thing, draw the same zone, press the same buy button, and hide their stop in the exact same place. To an algorithm, it's a bright neon sign. Liquidity here, come collect. So the market dips down, sweeps the low, fills the orders, clears the stops, and then finally moves in the real direction, the direction it wanted the whole time. Retail says, I got stopped out again, manipulation. But no, you placed your stop in the most crowded spot on the chart. That's not manipulation, that's the rules of the game. The second reason algorithms need retail to lose is this. The market can't move without liquidity. Every buy needs a sell. Every sell needs a buy. Every big position needs someone on the other side of the trade. And guess who that is most of the time? Retail traders with stops. Retail traders chasing breakouts. Retail traders fading trends. Retail traders fighting narratives. Retail traders trading based on emotion rather than structure. Every time you enter too early, every time you get faked out, every time you revenge trade, you're providing liquidity that keeps the system running. Your loss is the fuel. This isn't personal, it's structural. If retail suddenly became disciplined, patient, and consistent, liquidity would dry up, and the entire machine would struggle. But retail is emotional, inconsistent, and predictable, so liquidity never dries up. This is why algorithms need you to lose, not you specifically. The behavior? The third thing to understand is that algorithms exploit timing, not just price. Retail trades emotionally, algorithms trade mechanically. That difference in mindset creates predictable patterns. Here's how most retail entries look. They buy too late. They sell too early. They chase candles. They react to fear. They panic when price pulls back. They hesitate at the exact moment they should take the trade. Algos know this rhythm like a heartbeat. Every retail panic is a liquidity grab. Every retail chase is a liquidity injection. Every retail hesitation is an opportunity for smart money to position before the real move. The algorithms don't care where you enter. They care where you're likely to exit, because that's where the liquidity sits. You're not losing because you're unlucky. You're losing because the market is exploiting the patterns you repeat daily. So how do you stop feeding the machine? You don't beat the algos. You join them, philosophically. You start waiting for liquidity to be taken instead of providing it. That alone puts you on the correct side of movement. Stop buying the first bounce. Stop selling the first break. Stop hiding stops in the most obvious places. Stop chasing candles in the middle of nowhere. Let the market run your old retail self first. Let it clear stops. Let it sweep the level. Let it create the trap. And then trade the displacement out of that sweep. This is why setups like the Silver Bullet or FVG breaker models work. Not because they're magic, but because they position you on the other side of the retail trap. Your job is simple. Stop acting like the liquidity. Start acting like the one collecting it. Thanks for watching. Please like and subscribe.